Hey everybody, this is Jennifer Hornick and Bob Palestri, the Palestri Group, serving buyers and sellers on Long Beach Island and in Northeast Florida. Today we have two top producing mortgage specialists here with us. We're going to discuss a topic from a buyer's perspective of how you can use a rate buy down when you're making a home purchase. We have Meredith Medvec from Prosperity Home Mortgage here in Northeast Florida. And we have Mike Carvajal from Informed Mortgage, and he serves both Long Beach Island, New Jersey, and Northeast Florida. Actually, all Florida. So just to get started, I don't know if you guys want to just say hi and get right into the topic.
Hello everyone. As Jennifer said, Meredith Medvec with Prosperity Home Mortgage. I also serve all of Florida. I've been lending for just over 20 years, so love the topic of buy downs. I think it's very time appropriate, so excited to talk about it.
And again, I'm Mortgage Mike Carvajal. I've been in the game 24 years. I love what I do. Temporary buy downs are the most underutilized program that we have. I just think it's all about education, and that's why we're here today, and just really excited to hopefully open up some eyes and help some people together.
So basically, I was introduced to the concept of the buy downs when we had a surge of inventory in Northeast Florida, and there were a lot of homes on the market. And what can we do to try and entice a buyer to buy our home? So I started hearing about these rate buy downs. Now, in educating myself with these professionals, these have been around for a really long time, but I just heard of them, and that's why I want to really bring these to the forefront. And today we're going to talk about, as a buyer, if you are looking to buy a home, how does it benefit you rather than going to make an offer and making it for less than the asking price? Why would you instead ask the seller to buy down your rate? How does this make the transaction better financially for you? So that's what Meredith and Mike are going to get into now.
Yeah, you
All
want me
right,
to start, Jennifer?
take
Sure.
it away.
Yeah, so I mean, how it benefits a buyer is really, you're getting a rate for that first year that is 2% above whatever the market rate is based on that specific scenario. So let's say, a 30-year rate is at 6.75. That buyer would be getting a rate for 12 months that is 4.75. Everyone wants to hear a rate in a 4 or 5 number at a minimum, right? I think we got so used to those 2 to 3% rates.
Right.
So certainly hearing a rate that has a 4 in front of it, 4 or 5, would be really exciting to a buyer to save them hundreds of dollars per month. And then in that second year, they would have a 1% reduction in their rate from that example of the 6.75. So there's just money being saved in years 1 and 2. The idea behind this is just really simple. Our hope is that we're going to see interest rates trend down over that 24-month period. And at that point, the buyer hopefully would be able to refinance their loan and take advantage of rates once we see them trend downward. Simple as that.
And to piggyback off of that, what's nice about the temporary buy down, everyone, is let's say, so for instance, on a $500,000 home, if you put 5% down, right, going conventional, if you did a 3-year buy down, so if you did the max buy down that we have, the total buy down cost for the seller would be $21,779. So they were going to sell their house for, let's just use $20,000 for analogy purposes. If they were going to sell their house for 500 and they had to lower it to 480, per 10 grand that you borrow on a 30-year fixed mortgage as a buyer costs about $64. So if you're going to go 500 and you beat them down to 480, congratulations, you saved what, $128, which is 2 shots and a beer at any good bar, maybe a ham sandwich. Versus if you did that same math and you offered the seller $500,000 with a $20,000 temporary buy down, do you know it would save you, me as the buyer, $892.42. That is 3 beers, 2 shots, and 5 ham sandwiches for sure. So the difference is stunning when you look at it from that perspective. Furthermore, let's say that rates drop to 2. Trump comes out and says something crazy. Okay, rates go to 2%, but I just paid, or the seller just paid $20,000, Mike. What am I going to do now? I want to refinance. With a normal rate buy down, with a normal discount point, you made your bet. The bank got your 20 grand. It is what it is. You refinance, you lose it. With this point, y'all, guess what happens? Whatever's not used, so let's say there's 18,000, 16,000, 15,000 left of that temporary buy down. You've been paying in 2, 3, 4, 5 months. Whatever is not used gets put against the principal of the loan. So I'm refinancing someone right now. We did a temporary buy down. They need to do some things. They actually need some cash out. So I'm now re-amortizing and recasting their loan. And I'm in a position where the 20 grand or 5 grand or whatever that number is, it goes right off their payoff. So there's no, I grew up Catholic. There's no Catholic guilt on that one. You're always going to have it put directly against the mortgage. And that is why, again, Meredith can back me up on this. We feel in our industry, it is such a win-win. And we're just trying to shout it from the rooftops to get it out there to the masses.
Just
agreed with all of that.
Meredith, maybe you can repeat what Mike just said, because this is the whole point of why I wanted to do this, was to explain that huge difference in the pocket of the buyer when we're looking at offering 20,000 less versus using that towards a rate buy down, how the difference for them that makes. So maybe if you can just give us another scenario.
Yeah, I mean, so I'm not at liberty. I'm only have one screen right now, so I can't do all the mathematics behind it like Mike is. So he's at a huge advantage. But like Mike gave you in that example, that concession that the seller is ultimately paying is what the buyer is saving. Okay, so you're just dividing that over those 24 months. So in his example, that buyer was saving, I think, Mike, you said like 800 and some odd dollars.
892, for a 3-year buy down. So their initial rates, I just had it in here at 699, for the rate. So that means 399 is their first year, right? 499 is their second year, 599 is their third year, and then finally in the fourth year, y'all, that's where it goes to that 6.99.
Yeah, so there, the savings for that buyer on a monthly, basis is huge. And that is why this is such a, important thing to put out there as a seller, to be honest with you. If you're trying to move a property, is incentivizing these buyers where it's hitting them in the pocket. And with the economy, we all know the way that it is, with things costing so much more. What buyers are hyper focused on is their payment.
Sure.
That's the bottom line. So how do you fix that pain point? Everybody knows that rates aren't where we'd ideally like them to be. We'd love for them to be lower. Now we do have to be reasonable with our expectations because, to think that rates are going to be 2 or 3% is not realistic. But I do think that, I hope we get back in a range where we're in the 5s. That would be wonderful. We'd have way more affordability. But getting back to the topic, you've got to be able to figure out a way, like, how does this help get buyers to buy homes? And how it does is by lowering their monthly mortgage payment. And even though it's temporary, these are temporary buy downs, it will help them bridge the gap of allowing time to pass to be able to refinance, hopefully in the future when we see an opportunity for them to do that. And so, great example that Mike gave. Again, he's got all the numbers behind him there, but it's a huge savings. And it's just truly a win-win in this market for both a buyer and a seller. And I know this call is mainly about buyers, but it's all about payment. People's payment is what they are focused on.
And when I originally think about this, I think about this in a market where we have a ton of inventory and a lot of competition. And how do I draw a buyer to my house is I offer them this buy down. But then in extrapolating that, because in Long Beach Island, we have very limited inventory. So there's a lot of competition, but still, why not, as a buyer, ask for this? I think that in any market, whether buyer's market, seller's market, it's a tool that everybody should be using.
And it can be used for second homes. So that person buying in Long Beach Island, New Jersey, or in St. Augustine, Florida, like that might be a second homer that can't necessarily afford that bigger nut, but saving $892 on a $500,000 home, that is significant for me. I can tell you that.
That is a great point, Mike. I
So,
didn't even think about that, but yeah, as a second home,
yeah,
this is absolutely, yeah, even better. That's a great example.
Yeah.
yeah,
Bob, were
I
you
don't,
trying to jump in?
let me jump in for a second because I know LBI. I've been selling here for 20 years. I know the buyer. The average home is now 2.2 million. I don't think my buyer gives two turds about saving $800 over 3 years. So no, I'm not sure how this applies to.
It's not necessarily for jumbos. You're right, Bob. Again, those people, it is what it is, right? But for the rest of the masses, they could use it.
I also think there's a lot of people buying on LBI that are going to stretch their budget to get that LBI home.
That is true.
So
Yes. I
they,
just,
there's a lot of people that would stretch, and this might help them.
Ooh, another thing, as rates drop, do we think it's going to get easier or harder for buyers? It's harder, okay? Per rate that goes down. If rates go from 7 to 6, 6 to 5, 5 to 4, this is nerd stuff just stuck in my brain. A million people come into the market, whether you live in St. Augustine, Florida, Long Beach Island, New Jersey, Compton, California, Detroit, Michigan, a million people, a million new buyers come into the market. So
True.
for all you buyers that are sitting on the sideline, this is a way for you to get in. And okay, rates, were high and now they came down. Let's say rates stay the same. And unfortunately, your payment's going to go up, right? It's not an adjustable rate. Your rate's not going to go through the roof. You know where it's going to be. Secondly, do you think you're going to make more money or less money in the next 3 years? God willing, most people don't make less money. Wages do have to go up. Unfortunately, not as much as inflation over the last 4 years. However, I know and I pray that I'm going to make more money in 3 years than I do right now, which is going to help offset it. Or I wait and I keep spending $2,000 or $3,000 a month at a 100% interest rate because you get zero of any rent, right? So what is the better call? I just sit on my hands and I wait because I think rates are going to come down, or I'll come up with another $20,000 for a down payment. Do you understand how hard it is to put away 20 grand? Families out there, bring it on. You show me the easy way to save $20,000 annually, and I will come to you for financial advice because that just in most of our worlds doesn't happen. Versus saving $892 a month on a $500,000 house and then figuring out in the future when your house at a 4% appreciation, 5 times 4 is 20. That means your house is going up annually at 4% over 50 years. I don't care where you live, roughly $20,000 on a $500,000 house. In 3 years, your house is now worth $560 versus $500 when you paid for it, give or take.
Yeah, I think it also, I had a scenario recently with a buyer who she found a home in the community she wanted to be in, mainly because of, her small child going to a specific school. And, she came to me, she kind of told me what she wanted her payment to be, because that's a really important question with buyers is, what are you anticipating paying monthly? Because a lot of times they don't line up, unfortunately. Right. So she came to me, she kind of told me what that payment was. And then she had this very specific house that she was interested in. And it didn't line up. She was 1,800 to 2,000, and I think this house was more like a 2,500 a month scenario. And I reached out to her realtor and asked if he was familiar with 2-1 Buydowns, and he admittedly was not. And but he's a smart guy, and I explained it to him, and I said, you think this is something that you would be able to negotiate on behalf of your buyer to get her in this home that she really wants? And he said, yeah, I think so. So that's exactly what he did, and that put her in line with those payments where she wanted to be. And we closed that deal 2 months ago. Sure. Otherwise she would have been in a house that she wasn't really wanting to be in, to be honest with you. And yeah, there is always some risk, involved in almost any financial decision that you make. But, you do understand what your payment, will be like, after those 2 years. And, like I said, we're basing this on, economic forecasting of people who I would say, I don't want to speak for you, Mike, because you sound like a pretty smart guy. But these folks that do this are way smarter than I am when it comes to mathematics and
That's
predicting the
it, nerd.
future. Yeah.
That's right. I wear the glasses, but they're the real nerds. Yeah,
Yeah.
absolutely.
So we're just basing it on people that know these things, and what they're predicting for, the next, 12 to 24 to 36 months. And so hopefully we will see an opportunity for these folks that take advantage of these 2-1 buy downs or 3-2-1. There's many options.
Sure.
That they'll be able to refinance hopefully in the future and take advantage of rates. Because one thing we know about interest rates is if you look at them, even over 50 years, they go up and they go down. And markets are, they're just cycles. That's all it is. And so, yeah, this is a great option for a buyer right now in our market. And I'm glad that you're putting the word out, Jennifer, because this is something that if I could get every realtor to do this,
that'd be huge.
That would really move the needle.
Yeah, we can help so many people.
We could help so many people.
Well, I really appreciate. Go ahead, Mike.
Just last thing. Okay, that analogy, 500,000, 5% down means you're paying mortgage insurance. Everybody, mortgage insurance means that I couldn't afford to put 20% down, so now I got to pay this stinking rotten fee every month to an insurance company. It's $75. It's not that much, but in this scenario. So what happens? Okay, I wait 3 years. Now my rate's gone up, or 2 years. I just ran a loan to value calculation. I'm a nerd, 84%. So your loan to value went from 95% in 3 years to 84%. So now your rate went up a little bit, right? But now you go to refinance. Now your mortgage insurance drops because you were in the house 3 years and you didn't spend rent for 3 years. So again, that proverbial, I'm on the fence. Should I rent and save 20 grand, or should I buy now and take the temporary buy down? 1,000%. I am not the smartest guy on the planet, but that is the better option. 1,000% to buy with a temporary buy down. Let the appreciation at 4% now. Again, I'm not being crazy on an appreciation scale. At 4%, you're going to have a 12% appreciation over those 3 years, and thus the mortgage insurance is going to be cheaper, even if you have to take the same rate, and recast it at that point. It's still going to save people money in the future.
Thank you. I really appreciate you both coming on and talking about this. I personally love this. It's so exciting to me. If you are listening to this and you're not excited about the possibilities of this, I'm not sure what you're missing. But and if you want to talk about it more, please, I'm going to be putting Meredith and Mike's contact info right under this video. Reach out to them, give them your specific scenario, let them run the numbers for you, and use this to your advantage. Don't wait on the sideline and miss out on something. Because especially with these vacation homes, I have people that are like, I'm going to wait. The prices are going to go down. No, they're not. I'm telling you, they're not. So don't wait. Just buy the house that you want now, whether it's your primary home, whether it's your vacation home. And with that, thank you guys again. And hopefully we'll be doing some business.
Thank you for having us. It's awesome.
Thank you.
Okay. Bye-bye.
Bye.